Okay, welcome everyone. Welcome to the Hurley Investments Market View commentary for the 11th. I believe we have one more on the 18th. We need to apologize for last Thursday. Last Thursday, Kiev had to cancel the trade findings and adjustments, and I was not able to jump in and substitute for him. So we apologize for not having the trade findings and adjustments available on Thursday. With that said, I'm kind of interested in some some comments here. If you are going to talk about 2024, and I'm opening this up to the group, what do you think? What are your guesses? What are your estimates? What would you tell me about 2024? The other day I said on average, it's an 8.5% election up year. That also goes for an up 7.5% bond market. So there's a contradiction where the bonds and the equities are going up at the same time. I have bullish until millage. Funny. So we have bullish start, and then at the same time, I have a down year with a recession. So Dave, why don't you think that? Why would you think that? A down year with a recession. Election year, so maybe some rate cuts. Rate cuts stimulate the market, right? Election year, so maybe some rate cuts, even though not supposed to be political. Wink, wink, right? So stocks should go up, make people happy. I like that one. That's a 100% possibility there. It's funny, I saw this one. Invest in oil and banks. What else did I see on CNBC? Invest in oil and banks. Evercore ISI sees a big pullback in the first half of 2024. Yet at the same time, where was the other one? Oppenheimer has a bullish outlook for 2024. Another one, HSBC hit a new high beginning of the year, but will the stock market rally last? All right, so I'm typing all this in because basically looking at the news, right? Just looking at the news, and Bill beat me to the punch. In fact, I'm going to kind of copy that, right? Translation. No one knows what will happen. And he says until it does. And I agree. A lot of what you're going to see out there is going to be from models. A lot of what you're going to see out there is from past history, where they're going to relate to some point of something that they've seen in the past. In 1923 and 1971, the reality is, if it hasn't happened in the last 20 years or 23 years in the millennium, in the new millennium, I'm not sure how much bearing it has. There will be a lot of trying to justify. You're going to hear a lot about, well, there's an algorithm, right? Our model, Our model, our algorithm says this. It's the future. Nobody knows. It's kind of funny that we have all of these interpretations, because the fact of the matter, nobody knows. Nobody knows whatsoever. Now, this actually is going to run into something I wanted to go over different. I'm going to cut this one out. Here's what I'm going to tell you through all these years. Diversification never was protection. And I will go ahead and I will challenge anybody to question me on this particular comment. Because I know in 2020, when we had our stealth bull market, people were diversified, got killed. Down year in 2022, even an up year this year in 2023, but with the rate hikes, the 60-40's dead. 2008, everyone got creamed. 2000, 97, 96, 93, 90, 87, 83. I can go through all of the big, huge drops. And there was never, ever a diversification that worked. A couple of you just typed it in. When the tide goes out, all the ships go down. Now, it's interesting because, let's see, Harry Markowitz, Modern Portfolio Theory. Nobel Peace Prize winner, right? There we go. So they're little pieces to the Harry Markowitz efficient frontier model, and it's everything from emerging markets to small caps to REITs to mid caps, international equities, large caps, large cap value stocks, high yield bonds, long-term bonds, international bonds, short-term bonds, muni bonds, intermediate short-term bonds, cash, U.S. inflation, and the inflation rate that is supposed to all fit on that line. And so the goal from all these projections is, if you want the most efficient, you put those 29 points on that line, and they're allowed to have a standard deviation of like 0.5%, top or bottom. And I just found it really interesting because in real life, you just don't have a way to create I'm trying to get this a little bit bigger for you guys. You don't just have a way to create this opportunity to see this. Fit to window, come on. Dang it, I'm doing a horrible job of having this up and going for you. It's impossible to put all of these on that line and to have them show up in a way that it's always on that red line with that littlest amount of deviation. It just doesn't work that way. But here we have the efficient model, and all those models are built on a way to predict 29 different components. They're going to fit on that line and not move 2.5% one way or the other. And that's what all these models are based on. It's outguessing not just the S&P or the NASDAQ. It's outguessing 29 individual points and having them run onto a way that is going to fit. And I'll cut this slide out and I'll put it into our notes. But that's how diversification is supposed to work. Nobel Prize winner, and you put 29 different diversified pieces into a portfolio, and somehow you make them all on that curved line, and you're going to make it. You're going to be there, which is shocking because in real life, in theory, it sounds great. In practical application, it's impossible. But if you can lie to people enough, the theory overtakes real life somehow, which is hilarious. A little something about individual stocks, right? Someone asked me recently, hey, Kevin, you're doing or using individual stocks. And this is from a gentleman that writes the rant. I really look forward to his comments. He says it all right. He does his research, but he's a little bit on the extremes. And the author of the rant, and I checked his numbers, and he's exactly correct. After all the ups and downs, the S&P is right about where it was on July 31st when it was a tad higher. While it is up 10.6% off the October lows, the reality of the gains are almost driven by the so-called Magnificent Seven tech stocks. Of the 18.24% gain for the year, 14% of the 18% is purely due to those 7 stocks, which make up a vastly disproportionate share of the S&P 500 index. The P multiple is 18.6, but if you take out the 7, then it's a 16.4. Earnings overall are below 2022 levels. So you need to be very careful not to think the stock market is doing really well this year. It is for the few big tech stocks, but for many others, it has gone up only a little or down. And this is from the rant, and I'm going to give credit where credit is due. Those 7 stocks have made up the gains of the year, which is why when you talk to us, we're a little bit excited. But when we're looking at some things, it's why we're interested in Disney. It's why we think Baidu has upside. The banks, which were supposed to go up in all these big rate hikes, or why we like Bank of America back up to 55 to 60. Why we like JP Morgan. It's why we think Under Armour has a chance to get back up to the 20s. It's why we like Ford back up to 25. I could go through a bunch of what we have here and what we're looking at on our positions, because other than Apple, I should put Boeing as one of our favorites in there that has a huge upside potential. Other than Apple, other than Meta, not much else has moved, which is why we're loving the process, right? Not much has moved in the last 2 years, which is why we love the process. Process, really simple. Make up money on the way down. Add more shares of stock I'm going to use Disney because it's a good one. Disney, we added shares down at $80.86 was our last pop. Right now, Disney's sitting closer to $92 and change. When stocks come back, we make an exponential return while everyone else breaks even. That is the process. Now, something to mention about the process. It has no timing. We don't need to outguess what the market does. We don't need to create a model portfolio over the Harry Markowitz Efficient Frontier and try to guess 29 positions that are going to fall on a individual line. It's just, hey, this is what we're doing on undervalued stocks. We do subscribe to the Warren Buffett, find those undervalued stocks. We just wish we were billionaires so we could all wait for some things to come back in a more timely manner than he's able to, right? We can't afford that. He can wait for forever. We can't afford that. We need things to come back quicker because we don't live off of hundreds of billions of dollars. But that is our process. And we're excited for it. We've been excited for it for over a year now. And the reason why is because there's so much that has not yet come back. With that said, I'm just going to make one other comment, and then I'm going to open it up to let you guys make a couple comments here really quickly. Just something I'm noticing that I want to point out. You've got to stop trying to focus, and I'm talking to a couple of you here. In fact, Dave, I think we had this conversation, so I'm going to point it out for Dave. And Mary, I think we've had the same conversation as well. Stop trying to make money on protection. The short answer is you don't make money on protection when the stock loses more. So yes, you'll make money on the puts as they go down, but you're not trying to make overall money on protection. You have to pay for the protection. You'd have to double up on protection every time a stock goes down. The stock will lose more than an insurance contract of protection on the process of heading down. The goal is not to make money on protection and stock ownership. The goal is to make something on the way down, to convert it to more shares of stock, and then to have that percentage return be higher as the stocks come back. So my comment is, don't be so hesitant. I mean, let me put it this way. We don't plan to make money on car insurance. We don't plan to make money on homeowners insurance. We don't plan to or want to make money on life insurance. That's not the goal of the insurance. It's not to make a profit every time a stock goes down. You shouldn't be trying to make money on it, because if the stock goes up, that's where your money's truly going to be made. This is your insurance, or when things don't go as you have planned, this is where this will help you out on the way down. So I'm going to open it up right now. I know I threw a lot at you right now. Anyone have any questions? Someone typed in, actually, two interesting questions. Someone typed in that you do not like Ford. correct. I do not like Ford. I have an article I'm going to go over on Ford later on. Ford is wasting money on electric vehicles, moving away from their trucks, which are their bread and butter. And for all intents and purposes, electric vehicles suck. Well, Kevin, I know it doesn't matter. A Ford truck will go 68 miles to the charge when it has something in the bed of the truck. Well, Teslas, again, my brother charged his Tesla and going to work and then coming and pick me up from the airport because he had his kids, another couple of, things to, I guess, errands to get some food, kids back and forth to school. The Tesla didn't go 100 miles in a day. It's not practical. The hybrids are more practical, but electric cars, even though we have Teslas, are still not practical for the majority of people, except for those that are probably in those big cities, right? If you're only driving 10, 20 miles to work and back again, and are going to go out to lunch that's only 5 miles away, it's practical. If you're going 30, 40 miles to work and back again, electric cars are not practical. And Ford is one of the worst at figuring it out. Kevin, I thought you'd put us in some of the big 7. Yes, we were in Apple, and some of you were in Meta this year. Everyone was participating in Meta to a certain degree from 240 up to 300. But yes, there's a problem with, for some of us, we can't be over leveraged in technology because the risk tolerance isn't there, nor would it look good in your portfolios, especially when how far they've dropped. So the biggest position in everybody across the board is Apple. Second biggest is Baidu, and then some select few, if you have over 1 million with me, the 7 or 8 of you, those people were in the shares of Meta. And Meta was the biggest winner this year. Apple comes in second, which means we have a lot of other positions that can really take off to end the year. All right, a couple more electronic vehicle things came in. Let's see. All right, so I'm gonna say this a little bit differently. Since gas is too expensive, the solution is to spend $75,000 to $100,000 on an electronic vehicle, right? Or more often than not, what most people are doing is someone has bought the $70,000 to $100,000 vehicle, and then after 4 or 5 years, they now get resold to those of us in that $35,000 to $45,000 range. The problem is that when there's a problem with the batteries in that 6th, 7th, 8th year, it's about a $23,000 replacement for the Model S on a Tesla. Kevin, how do you know? I've had 2 friends and a brother that just went through it. So please do not think you are saving the environment or that you're saving money on electric vehicles. In California, you have different tiers where even if you're charging at night, you probably were beating gas when it was at $4, but right now there's a good chance you're not beating the price of gas when you truly look at your electric bill. Someone made an electric vehicle with a gasoline generator charges the battery. Looks interesting to me. Yeah, so there are some that are doing that the wheels are regenerating and recharging the batteries, and there are some hybrids that are phenomenal. Absolutely phenomenal, and those are the ones that I'm seeing an interest in that really could be pretty interesting to pretty interesting to look at in the future. Let's just put it that way. Okay. Any other comments about anything that I've said here? So, Kevin, are we supposed to ignore the predictions that we're seeing for 2024? So here is my comment to that. You don't ignore, you read everything, but understand anything that comes out from a JP Morgan, an Oppenheimer, Evercore, a bank, a money manager, HSBC, they're all running it through some type of Harry Markowitz efficient frontier model, which I just showed you is 29 different variables that have to be placed on a line with a movement of somewhere between 0.3% to 2 5/8%. And so if you're okay understanding that their models are based on those 29 points being within that range for the whole year, then you have an efficient model that will predict the future. There is no efficient model that predicts the future. I wish Rich Mormon was in here. Rich Mormon the other day was like, hey, I'm going to trust you, Kevin. And I'm like, ooh, why are you going to trust me? And he's like, well, you told me to stay in Bank of America. And you said, hey, it's going to go up to $55. And boom, it did it. I giggled and I said, yes, I was amazing on that one. But I do that for all of my stocks. And the fact of the matter is, the fact that it moved in Rich's time frame, I did not predict. All I did is I took a reasonable multiple on a reasonable future earnings multiple, and I multiplied them together, and it gave me a small range of where I said it was going to go, and it just happened to do that, 60 days after I told them about it. So this is what I'm going to tell you is a lot came out today about 2024, and next to none of it is accurate by way of being some proven model. It's just a theory. And in theory, there are a lot of things that sound really, really good, but real life is not based on theory, it's based on practical application. And the practical application is there are a lot of things that change all the time. All right, let's keep going. The big picture, again, another one. Talking about how am I going to say this? Their predictions, right? What's happening? It's a very interesting read. I like it. What it all means, in about a year from now, we will know what it means for 2024. We don't know today. We can only make educated guesses. And the funny part is that I'm going to disagree with their next comments. Their guesses are not educated. Their balanced investment portfolio is not educated. It's bullshit from start to finish. I just want you to think about this because I know some of you are going, Kevin, you're killing me. How many of you have ever had a number or have paid any amount of money for a financial plan? If you have, just type in a yes. I won't name you. I won't tell you your name if you come up. So there's 2. We've got 17 of us here today. Anybody else? Anybody else? Just type in a yes. If you've received a number or you had a financial plan ever made for you or paid for you. Now it goes up to 4. So 25% of you, huh? Oh, there's one no came in. All right. So I'm going to say it's probably half of you. But here's my comment. Any financial plan, any number that these people come up with is based on an average rate of return that's compounded every single year. So if you've got 20 years to go, the average return is 7.75% on the S&P 500 when you add back in dividends. Can someone please tell me how realistic is it to expect the market to grow 7.75% for the next 20 years, compounding your gains annually? If anyone thinks that is a realistic expectation, would you please tell me how you've come to that conclusion? The model is broken. It's a variable market that they are assigning a fixed compounding return to. So, a word to the wise. Every time you start hearing someone talk about a financial plan, a financial report, a number, compounding interest, you have someone who has missed the premise of a stock market, who wants to feed you some Kool-Aid on a process that lines their pockets, not yours. And they will do nothing for you but pay a commission to put you in a fund and churn you through 2 or 3 of them when they don't work every 2 to 3 years. That's the competition that I have that's out there. And they go by the names of Morgan Stanley and Goldman Sachs and JP Morgan and Wells Fargo. In fact, that's the funniest one. Wells Fargo is in deep crap again for price fixing their mortgages and their problems there. And they bundled all that garbage that they faked into swaps and sold it to all their clientele. Why people would ever use Wells Fargo for their investment vehicle does not make any sense to me. I sit there and I scratch my head. All right, Costco reports on Thursday. Very interested to see where Costco goes. We might do some type of option play. I keep saying the markets are going to go higher. In all honesty, this week, I have no idea. It's 100% dependent upon the rate hike meeting on Wednesday. Dow Jones overbought. We are ripe for a pretty wicked pullback. We're at 36,404. The 50-day is 34,304. We are basically looking at a 300-point, almost a 10% drop till we get back to some parity. My expectation is the beginning of next year, we'll see that sell off and give up that 10%. S&P 500, bullish and overbought for longer than I've seen in the last 10 years. Well, it was slightly, it came back down, it went back up. 46.22, 39.93. We have about a 5% drop to become to parity. When you see the actual price run that much higher than the 50-day, the last time we saw something like that, there you go. There's your run back down. And that's pretty typical. Expectations, sometime in the near future, possibly this Wednesday, our market's ready to take a tank. NASDAQ, same thing, 14,432, 13,652. We have an 800 point drop where you move that 8.33%. Last time that happened this year, 14,446 to 13,161. That typically is the recovery. That is the standard. Goes up 8.33%. If it can't sustain it, we do about a 10% pullback. Then we run our next run higher. Something you should be paying attention to, that markets right now mathematically overpriced, overrun. Still calling in December up 2.5%. Earnings were Oracle today. Oracle beat on the bottom line, missed on the top. They're going down. Adobe on Tuesday with Johnson Controls. Thursday, Costco, JBL, and Lennar. Friday, Darden Restaurants. CPI reports. Tomorrow, PPIs on Wednesday with a rate decision. The market will be pretty flat tomorrow and Wednesday until the rate decision comes out. The risk is not that they're going to raise rates. The risk is that they will not say that they are done raising rates or will be in a holding period for an extended period of time. That is the risk to the market this week. Retail sales on Thursday, capacity utilization and industrial production on Friday. A couple interesting, an extremely rare stock market signal with 100% accuracy rate is flashing and points to a record highs in 2024. I kind of giggled because I received some of you guys sending me this. All I'm going to say is this. I call BS. I do. It always works until it doesn't. And this is somewhat comical. It is not accurate. Their numbers are not accurate. You've got to be smart on what you're being told. If you're trading off of this garbage, we need to have a talk. I really like this picture. 3 cryptocurrencies to avoid trading this next week, which is the week that we're in. I'm going to tell you, you avoid all of them. Yes, 2 years ago, I put $5,000 into 29 tokens in Bitcoin. Most recently, it was worth $330. Yes, I took the bullet, 29 tokens and Dogecoins and this and that and Bitcoin. $5,000 went in year and a half ago, almost 2 years ago, worth $330 today. I can go through every position and how far they fell if you'd like to see what garbage cryptocurrency is right now. All right, but I'm sorry, I threw it in there because I'm so negative on it. UX stocks rise even as bond yields jump after strong labor market data. Again, good news is bad news is good news. Every time bad news becomes good news, there is something wrong with the market. There's something wrong, and you've got to calculate this into, hey, there's a misunderstanding of the market that doesn't make sense. And then last but not least, Ford cuts planned 2024 production of electric vehicle lightnings in half. Yeah, here's the example on Ford is finally realizing, why don't you just spend your time doing that, which what you're good at, and that's just making those trucks. Yes, I've got a Ford. I love my Ford. 340,000 miles, same transmission, same engine, and I've used it a ton. All right, any questions you guys have for me tonight that I can answer? I know I threw a lot at you, and hopefully I'll have this recording for you, but any questions you have about anything I mentioned today, I'm here to answer for you. If you're going to watch this on the recording, I can see my back Eastern crowd, Kohler, Bosserman, Mormon. Give me a call. Give me a call, 720-841-4992. Questions? Any questions you guys have that I can answer? So, Kevin, what do you see new for 2024? So, I like chips. I like banks. Both are completely underpriced. And you had this conversation with me, Dave. So yes, I'll have the same conversation with the group one more time. Why do you like banks, Kevin? Well, they didn't get the bump they were supposed to with the interest rates running higher. So maybe they'll get their bump with the interest rates running lower or staying steady. I actually like them because they've done better in their fixed income, usually meaning commercial and residential real estate. And I think if rates can go down a little bit or stay steady, that bodes well for an election year next year. Also, it's an election year, so I figure we're going to get some help from the government as they try to bribe the votes that they need, one way or the other. I do think either party does the same thing, so it's just the way our election process goes. I will tell you, voter confidence has to be at an all-time low. So it will be surprising to see what happens going into next year and the voter confidence that people have. All right, I don't see any other questions that are coming in. So for that, thank you guys for being here. I hope this is helpful for you. I hope it gives you a way to look at everything that's going to be coming at you in the next couple weeks. You will be bombarded with predictions. And I want you to see where those predictions were coming from so you understood what someone else is trying to tell you. Someone else has it figured out how they're going to put 29 points on a dot plot that moves 3/8% to 2 5/8% in the next year, and they've predicted that all 29 will fall in that range to be on the efficient frontier model. And I'm going to disagree 100%. Abraham, do I use Thinkorswim? I do not. I'm not a big fan of all the tools from what used to be Invest Tools that's now Thinkorswim. I do have an account with them, but there's nothing proprietary that they're doing, whether it's their scanners or anything. There's nothing new that they have that I would see gives me an advantage to paying money for one of their screeners or platforms or anything like that. So I do not use Thinkorswim personally. I still have trusts with E-Trade, and my own personal money sits with MoneyBlock right now. That I am trying to move trusts over. I just have to sit with the broker for a certain period of time, and I did not move them over to Schwab. I was again held back from doing that. So that's the platforms that I'm using right now, primarily MoneyBlock, but I do have a trust sitting at E-Trade still, and it's not by choice. I would move that over in a heartbeat if I could. Any other questions? If not, guys, I'm going to see you next Monday. Again, I'd like all of you to enjoy your Christmas. This is really this is going to be a good Christmas for me to, again, crunch my numbers and to kind of be thankful that I still have a son that's around in relatively good shape. It's not every day you have a traumatic brain injury survivor that is functionable, not high functioning, but that functions, that isn't a vegetable. So I'm going to be pretty lucky to have a more mellow Christmas this year. All right, guys, have a wonderful night. I don't see any questions coming in. I'll talk to you next Monday. Good night, and take care of yourselves. Bye-bye.